Well, hello everybody and welcome back to another webinar. It's been a few weeks and we're really excited to be here today to obviously be discussing the Wyckoff Method and how we use this in different market instruments to really gain a bit of an edge on markets and also understand what's moving on. My name's Thomas Atkinson, and as always, I'm joined by Tyrone and Abela. Tyrone, how have you been? Been going well?
Hi, everyone. Yeah, welcome. Good, thank you. Yes, I've been really well. And looking forward to tonight. Actually, we've had a lot of people ask about this and we've been promising it for a while. So hopefully you're going to take a lot from it and be able to apply it to the markets. And when you hear us talking about it, you'll know what the hell we're talking about. So yeah, it should be good.
Absolutely. So just before we obviously get started, we do have a quick risk disclaimer. So we'll just quickly put that on the charts. We do need to make everybody aware that obviously this is for educational purposes. So let's get started in just a second. We'll be back in a minute. All right, so Tyrone, we're going to probably need to disappear from this chart for a few seconds and get into some slides. But I'll tell you what, Wyckoff Method is amazing. And it's one of the best ways of recognizing two of our favorite things in the market. That is the beginning of trends and obviously two of the concepts, accumulation and distribution. Many different people out there have it. I guess they call it different things, but really it's in essence the same. And we'll be talking about that today. But there's so much to uncover when we start to understand markets a little bit better. So today we'll be talking about how to trade the Wyckoff Method, key timeframes for this type of strategy, how we can possibly build it into a trend that's already moving and starting. Obviously, can we use it on smaller timeframes? A question we might ask. We also will be looking at some advanced technical analysis, always important, and of course, live Q&A. We do encourage you ask questions throughout today's session, and we'll be going through some theory, and then of course, we'll cover off based on that theory into some practical applications into the market. Are any Wyckoffs setting up right now? Do we have distribution? Do we have accumulation? And all of that good stuff. So let's get into it, Ty, by following, I guess, the words of the great man himself, Richard Wyckoff. He says here, successful tape reading is a study of force. It requires the ability to judge which side has the greatest pulling power, and one must have the courage to go with that side. You know, it's interesting. I did a speech recently, Ty. We did a talk, and I talked about Stanley Druckenmiller. And Stanley Druckenmiller is one of the greatest traders of all time. If you're not aware of him, many people aren't. He was a man that not only did he trade with Soros, obviously, he really came up with that idea of taking on the sterling all in the 90s, but on top of that, he also averaged, I think, 30% per year on huge funds, which is not easy to do. Remember, huge funds is harder than smaller funds to get those kind of rates. And I think he did it for like 20 or 30 years. So I often wildly consider him one of the best traders. And he says something similar. He says when he first got into trading, he was told bulls make money, bears make money, and pigs get slaughtered, Tyrone. And what he's saying by that is he's saying he literally said in his career he was a bit of a pig. Now that meant that he was effectively going against the grain sometimes when he believed he had an edge in the markets. And Wyckoff is kind of saying the same thing. He say you have to have courage to go with that side. So that's the thing. You have to have some courage. And can we get courage when we understand some of his great principles? So today we'll be covering off on technicals, as we said, the principles of Wyckoff, and then we'll really get into it. Ty, how important is recognizing accumulation and distribution? It's the thing, isn't it?
It is the thing. And look, a lot of it has to do obviously with supply and demand and support and resistance. And they all play hand in hand. The idea of where we want to buy and where we want to sell. What they are effectively telling us are those two important things. So at the end of the day, numbers are numbers and sayings are sayings. But at the end of the day, we want to know where we want to buy. And just as importantly, we want to know where we're going to sell. So accumulation and distribution are giving us the keys to really unlock that, I guess, idea of where the best places to buy and to basically sell your positions are. And I think this is why this method is great, because it's a different way of looking at as opposed to a standard support or resistance line, where we do talk about that quite often, because there are more things at play when we are looking at the Wyckoff method. So yeah, we'll jump into it and we'll have a look at a couple of examples shortly, actually.
Excellent. So let's get into some of the major, I guess you would say, instruments that you can use this method on. So yes, you can use it on pretty much anything. However, it will work best on really high volume, high liquid markets where there are a lot of participants, particularly the retail trader. Wherever we are, often Wyckoff presents. And that's because many, many retail traders don't understand the principles of really traps in the market. So gold, USD majors, major crosses in currency, and of course, major indices. We've got some great examples that we can bring in of those. These are all things that Pepperstone offers. And of course, it is present on all of them. We've got a currency one and we've got a major indice one today. So there are 3 laws that Wyckoff really came up with. The first law is the law of supply and demand, Tyrone. He basically said, if demand outweighs supply, the price will rise. Now, I know all of you are probably aware of this already, but his second one is obviously here, if demand is less than supply, the price will drop. Of course, very basic principles of really investment. However, I'd be surprised. Well, I'm not even surprised. Some people actually trade and don't understand those two things. He also said if demand equals supply, there is no significant price change and there can be lower volatility. And we'll come back to this one a little bit later when we understand how that really applies to the market. So that's his first one. His second law was the law of cause and effect. So that was that Wyckoff basically said that there is a difference between supply and demand, or the differences between supply and demand are not random, and instead they come after periods of market preparation. That's the important word. They come after market prepares to do something. So it's like really the market is kind of, sitting there doing nothing. And then all of a sudden, we call it participation often on these webinars and these live streams, Ty. And preparation is the key word here. In Wyckoff's terms, a period of accumulation, the cause, which can lead to an uptrend movement, the effect, and vice versa for distribution. So basically he's saying the accumulation level, if we can spot it, is actually the cause. It's the preparation. And then the effect of obviously that uptrend movement when it breaks out is after that preparation, after the cause. So what an interesting concept. Again, it just helps us to understand these markets better. And when we see Wyckoff's strategy, you'll see how it all plays out. The next one and the third was the law of effort versus result. So Wyckoff's third law stated that changes in an instrument's price were a result of an effort, generally represented by trading volume. Interesting, bringing trading volume into the market to understand how many participants were necessarily doing something. So let's use a stock example. In this case, we'll use the stock such as Tesla. And let's say Tesla started to consolidate after having an incredible downtrend. So the downtrend all the way down, high volume, and then it started to consolidate. And that consolidation continued to have high volume. What that high volume would signify is a big effort. So that's where the effort comes in, the high volume down the bottom. And I'm sure you've seen this before. So volume remains high, even though it's been dropping. When it stays at the bottom, it remains high. The move currently in the market would be sideways. So remember we said we'd bring back that low volatility thing. The low volatility, effectively the movement is not very large. But what it will suggest is that high volume suggests a lot of transactions. So what could be happening? And I'll ask the chat this question. What is happening after, let's say, a stock such as Tesla falls off a cliff and then starts to get down here? What's generally going to be occurring here? Let's put ourselves in the mindset of the retail trader. Remember, there are only 2 emotions really in trading, Ty. And I'm sure the chat's going to get this in just a few seconds. But what is one of the emotions that people might be feeling down here? Let's see if anyone gets that. We'll read some quick shout outs here. We've got Warwick, we've got Dave, Gary, plenty of people that always come. Welcome to everyone. If you can as well, also give this a thumbs up if you enjoy the content that Pepperstone puts out there, specifically content that's a little bit different, obviously based on some of these, I guess, ideas and concepts that are very helpful to everybody. So if you do enjoy it, let's see if anyone gets this answer, Ty. Gary says,
I think a few people will. I think a couple of people are going to get this answer.
I'm not sure if there are. They are. So basically in the market, there's 2 concepts. And really, Wyckoff is figuring this out. And there we go. Schneider trades gets it. And he says, fear and greed. MJM also getting it here. So yes, fear is the emotion that people will feel. I've taken heavy losses. I'm sick of this. I'm upset about it. I made a mistake. I'm getting out. And then just as you get out, it reverses. And part of the reason that occurs, Ty, is because down in this area where there's high volume, there's a lot of manipulation of our heartstrings. We've already taken significant losses. We bought the dip all the way down. Okay. That's what some people do. They DCA, they dollar cost average, all these types of things. It gets to the bottom and then it starts to waver. And at some point, and really this is where Wyckoff comes into its own, at some point, sometimes during this accumulation, it spikes through and has a thrusting action. That thrust will come back too soon, effectively creating a false breakout. Now, what does that false breakout do? Well, when you get the rally and it comes back down and it rallies again, think about our human psychology at that point. What is going to be happening? Well, we might say, look, we've already seen the low. I can't take any more losses than that. I've already got so many losses. I know what I'll do. Big brain, I'll put my stop loss underneath the last lows. That's what I'll do, Tyrone. I'll put it right here. Well, that's a great idea, isn't it? Unfortunately, the market is sneakier than maybe you think. And it comes down, it false breaks to the low, reverses. And then for anyone that didn't do it here, it continues to do it and sometimes does it again and then goes off. And that is what Wyckoff is really trying to teach us all the way back from when he came up with this method so long ago. He was trying to teach us that there are participants in the market and they're super sneaky and they'll take advantage of our basic human psychology.
Yeah. And I think what's important probably from that, even though this was many years ago when it was constructed, is that what we probably really have learned is that human emotion, despite all the technological advances and all the different markets and everything else that you can change, human emotion hasn't changed. And I think that's probably what he's trying to highlight there. And that's why it's still effective even now, that, you know, if we were doing basically surveys of all different types of traders, they're going to come and really make the same mistakes that they were making, 30 years ago, 50 years ago, 100 years ago. Even though technology has changed, the same human emotions are the ones that actually cause these phenomenon, if you like, to actually work out in the markets.
So really what he did was he created a strategy called the Wyckoff's Composite Man, Tyrone. And some people here, David says, big institutional transactions. That's correct. That's what he's actually trying to get us to read in the charts. So as part of today's advanced session, we're going to figure out how we can read it, how we can spot it, and how we can start to play chess when everyone else is playing checkers. That's something we do want to be doing. So Wyckoff devised the Composite Man Theory. And in generally what this meant was Wyckoff created this idea that traders and investors should consider that the market was realistically just being controlled by possibly a single entity, that all of the market makers, everybody was kind of just a single entity. So essentially, this basically was market makers, the biggest players and everything all combined into a nasty trap. This will then allow us as traders, as investors, as people that are in the market to better understand how the potential market manipulation could manifest in price action. Remember, if we consider the market as a sneaky entity, which often it can be, and we consider that there could be traps from market makers and other big participants, then when we see those traps, could we gain confidence from those things? Absolutely, we could. We could see something, recognize it, and then trade with the big traders, with effectively the composite man instead of against them. So we always talk about these slides here, Ty, and that is the idea that we want to use what we call the lightning bolt. Now, in essence, pretty much every Wyckoff will also, or any trend really, will start with a lightning bolt. That is a trough, usually a peak, a higher trough, and a higher peak. And in essence, most theories all have the idea of running through a trend and following those trends, whether it be up or down. So let's look at a couple of them. This is Wyckoff's one. Wyckoff had basically a market would go down, it would become oversold, it would accumulate. It would accumulate hopefully in a certain way that would take mass advantage of the market. And then as it broke out, it would enter what he called markup phase. So that effectively was what we call the participation phase. Doesn't matter what you call it, it's the same thing. That's where the rally begins and the rally starts, and you want to be on board, obviously, if possible. Now, where you really want to be starting to think about it is through the Wyckoff accumulation area into this area here. Remember, we talked about Druckenmiller, and he said that you want to be a pig. Ideally, if you could buy into the breakout or buy slightly before and recognize the signs over here of the accumulation, which we'll take a look at soon, then you would be able to have successful trades. Then when the market was over, he theorized that there was a distribution area. It became overbought, and effectively large institutional big traders would try to dump their position to us, the retail trader, or other players that didn't understand the concept of the market, and that we would be the ones essentially left holding the bags during the markdown phase. So pretty smart guy, great concept. We also have the Dow theory concept. It's the same kind of thing, accumulation into public participation, obviously what we call it, into excess, which is usually some kind of euphoria. In this case, euphoria is greed, isn't it, Ty? One of the emotions. Into distribution.
Most definitely.
And then, of course, the opposite side. So really, it's the same kind of concept. Now, here is where it manifests. This is recent. This happened. We know the DAX. Obviously, many of you may trade the DAX. You might be from Europe. You may like trading the German market. I'm not sure. But here is actually a case of what we call Wyckoff distribution. And Tyrone, does this have all the hallmarks of Wyckoff and his thought process?
Well, it does. And I think this is probably a really good example of it, because I think that we do see the two, fake outs. We call them fake outs. And ironically, we hear it from a lot of traders actually at the time, where they say, oh, I got caught in a bull trap, or I got caught in a bear trap. Quite often they are actually describing what has actually happened here, even though they don't actually realize it. Because the irony is, most people know they've been caught out in a bull or bear trap, which is effectively what that is when you are getting caught out like that. And quite often when you actually review those sorts of trades, you will find that a pattern like this is actually what has happened. So it's really, really important to try and identify when they are actually forming, because that is how you avoid the bear trap or the bull trap, as we like to call it. But I think people actually caught onto this. I know a lot of people in our community did, and I know Thomas was talking about it as it was actually happening. Because problem with a lot of people's thought process is they say that technical analysis is only really relevant in hindsight, because you don't actually see it forming. But that couldn't be further from the truth, actually, especially in this type of pattern. And I think that's why it's so popular.
Yeah, so we'll actually dissect this pattern today, and we'll go through it, and then we'll find some live ones in the market that obviously could be setting up, some things that have set up recently, so you can see how it applies to different timeframes. Now, this actually was setting up on the weekly. Often Wyckoff will set up daily, weekly, higher timeframes, and there are a few reasons why it does that. But I'll just quickly answer this to a few people that mentioned here. Spyridon says, just started learning it. Excellent, that's awesome. And of course, Arpit here says, price comes to my stop loss, hits it, and then goes to the take profit. I've been there. I know what that feels like. It does suck. He also says another thing. He says, if everyone knows this was how market makers run it, are they stupid enough to see millions of people know this stuff? And then are they likely to make the same mistake that costs billions to them? Okay, interesting. So you consider basically that everybody knows a concept, because maybe you know a concept, or you found it on the information, or whatever. It's then being able to find it, spot it, and essentially trade it. It's not just as easy as saying, okay, I see the Wyckoff, I'm going to trade that. You have to think about bringing all of the essences together. Think about everybody knows maybe a Head and Shoulders. Now, in stock, let's say you're trading an index, an inverse Head and Shoulders would be a much better pattern than a Head and Shoulders. The problem is, though, Tyrone, and you know this as well as I do, that most people incorrectly spot these types of patterns, and they don't know what they're looking for, and therefore they're trading Head and Shoulders everywhere. Or in this case, someone said before, I see Wyckoffs everywhere. Yeah, you got to be careful about that.
Problem is, it's just like a normal chart pattern that we talk about, where people see them and they say, I've traded a Head and Shoulders, and I've traded an inverse Head and Shoulders, and they don't know what the hell they're doing. And most of the time they actually trade them wrong. So despite the fact that many people know about them, or they think they know what a head and shoulders is or an inverse head and shoulders is, you'd be amazed how many people actually get them wrong. Believe me, we see them. We see them every day. So we know, and this is no different. So despite the fact that everybody might know something, you could never assume that everyone's going to do the same thing incorrectly or correctly. That's for sure.
So Ty, we like to think of trends, and in this case, we'll be talking about distribution. So basically, we'll be talking about the end of an upward trend. We like to think of trends as parties. That is a spread of an idea or a concept. And when you think about it that way, it makes it much easier to understand the traps of a market. Consider a party that you may have gone to. And if you go to a party and it's really good, what might happen? A few people might call in a few other people, and all of a sudden it's getting gate crashed by, hundreds and possibly even thousands. It's all possible. A really good party will go euphoric in the markets and you'll get a massive move. A pretty good party will have some form of distribution at the end where people are left effectively holding the bags, or in this case, somebody smart left the building. They're like, okay, the party's done. Let's get out. And you're left sitting there.
The very important thing about a really, really good party is to make sure that you're gone before the police sirens come. And that is pretty much the same rule about the markets when they're hitting highs or they're hitting lows. And you think the party might still be raging on, but like Thomas said, you're the one left holding the bag when the police arrive. So the sirens are your alert. So that's what you've really got to look out for.
I like to also think, Ty, I don't want to be there to pick up all of the bottles the next day, or something like that.
You don't want to be the cleanup crew.
The cleanup crew is not that fun, yeah. So the first of distribution in the Wyckoff events is SI, so the preliminary supply, where large interests begin to unload their shares in quantity after the pronounced up move. So we have an up move, and then all of a sudden we get usually a little bit of a pullback, which is generally the beginning of the unload. Remember, when you manage billions of dollars, if not even more than that, tens of billions of dollars, you can't just press market like we can. We have an advantage over larger players because we can be nimble, we can be quick, whereas larger players, they have to sell over time. So generally, we see volume expanding generally this stage, and price spread widens, signaling that the change in trend may be potentially approaching. Let's have a look at what this might look like. So here's Wyckoff theory. Obviously, this is the beginning of the sell-off. Now, can we spot Wyckoff here? The answer is no. This is during phase A. Okay, very difficult for you to spot Wyckoff at phase A. I challenge anyone to be able to do it. It's called phase A for a reason. There are many phases. So we may not be able to necessarily spot this one, but that's the first. Then we get what's called the BC, or buying climax. So during this, it's often marked by, again, an increase in volume. Remember what Wyckoff's laws were. It was all about volume, big deal. And of course, price spread. The force of buying reaches its climax. Effectively, the party's really good. And it's so good. Everyone's there. Everyone's feeling pretty good still. Few people have started leaving the building, but it's still very, very good. This usually is marked by some kind of heavy or urgent buying. So you often see like a large candle coming out. So we have the SI that came in, and then we might have some explosive kind of candle. And that candle will go very, very high. And generally that will coincide with some kind of event. Now, if you're talking about trading, think about Apple. It's classic for doing a trap, not necessarily always a Wyckoff, but it's classic for doing a trap. We know Apple is traded heavily by us, the retail trader. So when we consider this, what often happens on the left-hand side of the screen before earnings? We often see a rise in price of the stock, somewhere upwards of 20 or 30%. Then we get earnings, and that earnings kind of sends the market into either a decline quickly after going rampaging up, or it has this last little spurt in it that goes boom and allows heavy transactional volume, because everybody, the retail traders, the other participants assume, wow, what a great earnings. This is fantastic. This is going to go up. They fail to think about it from the perspective of the market already went up significantly on the left-hand side. So often there is a buy the rumor, sell the fact. That's where the concept comes from, or buy the rumor, sell the news. Ty, how common is that concept in the market, especially when you start to see it?
Oh, most definitely. And it's almost, you're almost anticipating it. Like sometimes you actually, even if you don't see it actually happening, you're almost anticipating it at certain periods of time. So I think it's very important to understand, but probably the most important thing is to understand that it does happen. It is a thing. It's not just people saying it. It is actually a thing. And when you do understand that it is present and it can be present, you actually start to look out for it and see it ahead of time. And you can see it. I think that's probably, technical analysis in a nutshell, actually, when you can actually get to the level where you do anticipate and see things unfolding as they're unfolding rather than just looking in hindsight. That's when you really know that you've made it. And this is no exception. Buy the rumor, sell the fact, sell the news, call it whatever you want. When you anticipate it and you can actually see it playing out, it really, it weaponizes what you can do with that. Very, very important.
Love that idea, Ty. I call it clarity of mind. I thought about this the other day, and we've all got friends like this, and somebody mentions we have good analogies. I would say yes, we've done this for a while, so we get better ones all the time. But Ty, I was thinking about really smart people that are smarter than you and I. I'm not the smartest person in the world.
Where? Who are they? Where?
Yeah, right. We're talking Elon Musk kind of smart, these type of people. And when you find someone with a high IQ, really high IQ, what will they, or you don't want to necessarily be that person, by the way. It's not great in life, I've found. But what they'll do is we ask them a question, and they often sometimes look into the air, Ty, and they just kind of like do nothing. And then they look back at you and then they'll answer. And it will be a few seconds after. And you'll find that that's because they're contemplating the concept. They have a clarity in life. It's crazy. And then they're also like, how do I explain this to a Dumbo? how do I work this out?
And just on point, I've got to say, yep. you know what it's really, really funny about that? We're talking about high IQs. Thomas hasn't got his camera on. He's actually doing all of the mimics that he's actually talking about. I'm seeing it on the camera. and he's looking into the sky like everybody can see him. But again, there are smarter people than us, obviously.
The camera studio is not working right now, but that's all right. We're back over. So we need to show the people the Wyckoff theory here, Ty. So basically, we've gone through the two first concepts. Now, really, the essence here is we probably still can't spot it. And that is, we can't necessarily see the distribution yet. But when we understand, especially if there was a news event over here, and then that curtails to these points over here, so it leads on from phase A, we start saying, that makes sense. And we get a clarity. And that's really important. So again, in phase A, what else do we have? Well, we have what's called the automatic reaction. So the intense buying substantially diminishes after the buying climax, possibly the news, and heavy supply continuing. An AR takes place. The lows of this sell-off generally will define the boundary of the distribution. So really, at the buying climax, basically takes us to the peak. The AR takes us to the trough component or the low. So we've got the high and the low kind of at this point. Usually we start to get the high and the low, and then we can start to flesh out the concept of full-on manipulation. Okay. And this can happen faster than you think. Obviously, it doesn't have to happen on a daily or weekly. So we've done all of the first step. We've got our highs and we've got our lows. Then we go into phase B. Okay, phase B begins, and there's all these fancy little words here, and we'll just try to break it down to the key concepts. So in phase B, we've got the secondary test generally. So that is here, and this is where price revisits the area of the BC or close to the BC, the buying climax, to test the demand supply again and to obviously balance the price levels. So this is effectively now starting to create that big area here. Sometimes when this happens, we have supply must outweigh demand. Volume and spread should thus decrease in this area. And as price approaches the resistance of the buying climax, okay? An ST may take the form of an upthrust in this area. Now, an upthrust is basically represented by breaking through that resistance and then coming back down and possibly coming back all the way, okay? So this is effectively what happens is we have another thrust. That thrust goes up to the BC. Sometimes it goes further in this phase and upward thrusts and breaks through the resistance, creating a false breakout, okay? Now, again, at this point, it can be very tough still to be able to spot this as a trader. And that's where sometimes, you know, the old saying, Ty, it's maybe better for you to sometimes sit, wait, find your edge, find your quality here in terms of, you know, when you spot these things, and be reactionary to the trap rather than be predictive. So here we have the upward thrust, can get a lot of traders, the breakout, and then it reverses. And you think, what just happened there? Bam, straight back down. Again, can be difficult to spot at this stage. But we're getting to the point now where all of a sudden this becomes, I think, through phase B and A, we basically create the distribution that we're looking for. And especially if we have a false break to the upside and we come back down, we may not require the last components before it breaks out. Because remember, this is theory. We want to see practical application. So this is the first phases. The next phase is really about here, basically cause and effect to a degree. So phase B is as well acts as the consolidation zone, the cause that precedes the downtrend effect. During this phase, the composite man, remember we think of the composite man as just the market participant here, gradually sells his assets or sells their assets, absorbing the weakening market demand. So effectively, the market will just kind of hover around and float and just do nothing. The buyers and sellers are still present, but the composite man, effectively the smart market maker, he's just floating in the middle, selling his little positions off, not to alarm anyone. He doesn't want to alarm anyone. He doesn't want to tell them what he's doing yet. He just wants to say, you know what, I'm here. I'm selling. There's volume there usually a little bit, but I'm actually trying to dump my position to you. So again, sometimes the market will move above during this stage, as we discussed before. Let's now talk about phase C. So in some cases, the market will present one last bull trap here after the consolidation period. It's called UTAD, or upthrust after distribution. It is basically the opposite of the accumulation spring. So if we go back to over here, this type of thing here occurs. We sometimes have a breakout, a consolidation through that breakout, and it goes back into the distribution. So we either have upthrusts or we have this extreme upthrust that can occur and it comes in. And usually after maybe 2 upthrusts, you generally don't see more than that. I don't think you really don't see more than 2 in generally when I've spotted these distributions. It comes back and it begins the final phases. Okay. So these are the final phases of the market. So let's talk about the last ones here. Phase D. The phase D of the distribution is pretty much just the mirror image of the accumulation one. Of course, if we look at that, it usually has the last point of supply, the LPSY, in the middle of the range, creating a lower high. Remember, Tyrone and I talk about that all the time from this point. And then we get, of course, the test of the support zone. And that is evident usually by a sign of weakness or SOW. So let's just go back to this. Now, Tyrone and I obviously talk about lightning bolts all the time. In essence, Wyckoff really, I like a few things here. I specifically like the buying climax concept. That is, some kind of news creates the buying climax. Maybe it's a earnings result. Maybe it's an excess kind of huge upthrust candle, whatever it is. Some large candle here is ideal and a really nice euphoric kind of end to the move. Then that euphoric kind of buying continues and we get something like a UTAD or a UT twice, maybe once. We then start to decline. And during this decline, I actually really, really love this bit here if it occurs. And Tyrone and I love this. A consolidation at the support, like a coil, effectively, a coiling market, getting ready to break out. Now, that can show in a few different ways, can't it, Ty? It can show in a flag within the trend on the way down. It can show in a little kind of consolidation before the support. And if you see this kind of setup, especially with the coil over here, the movement down is explosive, isn't it, Ty? Very, very explosive. Yeah.
It is very, and it's funny how many of the technical aspects that we talk about actually form inside of the Wyckoff as it's setting up. A lot of people, it's not one of the ones that you want to be too trigger happy and get into, to be honest, because realistically, I mean, even if you spotted it at phase A, my question would be, well, what are you going to do with that information? Like, you don't want to be, if you're trying to sell it at that point, if you think this is actually a point where it's going to sell off after the Wyckoff theory actually sets up, or the method sets up, what the hell you buy? What are you selling it there for? Like, you actually want to wait for the evidence to build up anyway. So you don't want to be, this is one of those ones where you don't want to be in too big a hurry. It's like almost trying to sell a head and shoulders pattern at the first sign that the left-hand shoulder's forming. Like, why the hell would you want to do that?
That's correct. So we said before, we want to be playing chess, not checkers. To play chess, I believe you kind of need to see at least this component. That is usually not necessarily the UT has to occur here, but we need to see the buying climax. We need to see the sideways action, generally the volume, the sitting there, and then it becomes incredibly obvious if we're waiting and we're patient around either the upward thrust the first time or something like a UTAD. At that point, it becomes very obvious that we're probably in a Wyckoff. Now, that allows a trader to do a few things. If you're really confident in your distribution and accumulation, which obviously is the flip version of this, in phase C into phase D, you potentially can get involved. Now, Tyrone, you and I talk about scaling all the time. So if you believe it's a concept like this, obviously, if you're entering at this point, where would you be placing your stop loss? Well, you'd have to place it above this UTAD high, and that would be effectively your stop loss, and you may want to scale that position in. Then if it comes down and it starts coiling around here and it breaks down, of course, you have another stop loss that you can place, which will generally be above the coil or the last high in the direction of that trend breakout. So remember, there's real world in comparison to theory. And I think this is a great question here from Arpit again. It says, usually strategies explanations keep deteriorating by word of mouth. So he's like saying purple monkey dishwasher, yeah? People to people explaining to others. If I am the 10th person to hear about it, it might be explained in the wrong way to me. Am I correct? That is correct. That is correct. If people don't have a clarity to understand how to then trade it in the market, they go and they start contemplating it's always a distribution, it's always a Wyckoff, and they start to just think and trade it all the same way. Like, they just think everything's a Wyckoff. That's why we're saying here, Tyrone mentioned before, here is a bad idea to think you're in Wyckoff and you know what's up. Here is still possibly a bad idea. But if you see some of the telltale signs, e.g. this telltale sign right around here, and obviously the breakout, are all much stronger, replicatable concepts. Very
they're all tradable. At the end of the day, all of those moves are tradable. And that's what we want. At the end of the day, we want to be able to trade. So really, you've got scalping opportunities right through that last phase C and D. If you can identify it, you've got scalping opportunities to get to the points that you need to get to for the big swing trade, if you like. And that's the beauty of it.
So the last stage of generally a distribution marks the stage of, or the start of, the downtrend with a break below the trading range. So let's now get into some charts, Ty, like we said we would. Let's get into a few charts here and talk about some things that have occurred recently. So here is the DAX. I'm going to just use the DAX just as an example. So really what happened here is we obviously get that standard kind of movement out, the first area. We then go for the thrust that creates the first high. Here's the buying climax. So that's the buying climax. The sellers start to sell in these areas, though. I guess you could argue it's either this one here or this one here that's the beginning of the sale. Again, this is the reality versus the theory. We'll make that yellow to make it easier. Then after the buying climax, we put the low in, okay? There's the low. We then have an upward thrust. It breaks the zone. There's the upward thrust, okay? We go back to the low and test it again. We then have another upward thrust that breaks it. There's the second upward thrust. And then we come down and we create the series of lower highs, slowly getting ready for the breakout that occurs here. And there are a few things that you could have looked at here, specifically around the weekly. If you notice, some of you will go, that's quite clear there. The clearness is probably in something like this candle. You've already had one upward thrust. You then have a secondary upward thrust that goes and tests the high of that upward thrust level. reverses it and creates what you will know as a pin bar or ultimately as a shooting star. Okay, that's the candle. Now, once that follows through, especially after a long leg doji being, of course, indecision, it's kind of like a decision has been made. It becomes fairly confident that this is a Wyckoff distribution, that it has had 2 upward thrusts, that we have an amazing support level, obviously, that we can predict in the future, and that we are now looking for a series of weakness events after that. So again, this is the principle being put into the theory. That's what you're looking for. And at this area, you can start looking for that. It then continues to make a series of lower highs through here, Ty. Again, we go to the lower time frame. Let's go to the daily.
Comes back, touches the 20 moving average on a daily. Very, very happy days.
Look at that. So there's your downward trend series of lowered highs. I mean, it's obvious to us in history. I know you might say, oh, but Tom and Ty, you're talking about something in the past. I would encourage you can go back literally to when this broke. Ty and I were talking about the exact Wyckoff. We were talking about this exact concept, and a few people in the chat can definitely clarify that. So anyone in the chat that was around, let the people know that we were looking at this, because remember, this is a replicatable one. This is top notch. Okay. Now it happened on a weekly and it was very slow to occur, which is often the real signs and hallmarks of great Wyckoff distribution type. But
and that actually answers a couple of the questions. A few people have been asking what is the best time frame where it's most powerful, and that is that basically answers that. Really, the bigger the time frame, the more powerful the signal. It's really like all TA, all of the patterns that we talk about, all of the candle setups. The bigger the time frame, the more significant the pattern, and that's no exception in this instance.
Now, a few people are saying, but we didn't get some of the areas of Wyckoff that his theory is. Now, Wyckoff also stated that nothing is necessarily exactly the same. That's why I've talked to you, and Tyrone and I have talked to you today about some of the signs we look for. We look for the BC, effectively the input into the low, and then we look specifically for the false breaks. That is the upward thrusts in this case, and obviously on the accumulation, the false breakdowns. You don't have to look, theory and real world application are different, but after you get that upward thrust and it starts to weaken off the way it did here, it becomes significantly more likely that you have amazing day trades in here. And when, of course, it busts through, that's when, as answer to our pit, this is where everybody does end up seeing it. And of course, in this case, it went down. Now, I'm going to ask you in the chat, being big brain out there, obviously a lot of high IQ, I'm sure many people, 200 plus, yeah, we're all chess champions. What do you think that Tyrone and I would prefer in the markets? Would we prefer a distribution Wyckoff or an accumulation Wyckoff when we're talking about indices, stocks, commodities? Which one?
Here's a clue. We mentioned the answer earlier in the session.
don't. I don't want you to tell anyone these things.
See me actually has a question. He says, "Is there what happens after phase E? Well, after phase E, I think you can go to the pub. Really,
that's the idea, isn't it? You said, well, what you do there is you set your levels for the next logical kind of support resistance zone. Now, Wyckoff does have a theory or a concept about maybe we should be taking profit, but in essence, it's really the end of a trend and the start of a new one. So for an example here, let's say we believe this was a Wyckoff accumulation. Nice, dirty downtrend, certainly a huge kind of capitulation followed by plenty of little sneaky downward thrusts here to take out people and a great accumulation right around here, what some people call the SOS area. So for this one, it would be this profit here around this area. And you'll notice, look at the powerhousing of the move into that area. So if you, again, spotted something like that, which is what I want to show you, this is a 2-hour euro, okay? Now, it's not going to be, El Clasico as good as that weekly that was formed on the DAX, but it has many of the same principles. We obviously get the first one. There's that AR. Then we get the selling climax. We've put the low in. We put the, obviously, resistance in here. So there's our selling climax in this case. We then go down and we thrust down. In this case, we create a new low. We thrust down again, and then we move back up we've now got effectively what many of you will think as a channel. Yeah, we actually learn this pattern. We learn Wyckoff's concept all the time. You'll think of it as a channel. The power of it, though, is not so much that it's a channel. The power of it, Ty, is the fact that it has nasty traps in it. That is, when you put yourself in the perspective of how you began trading, would that downward or upward thrust have either got you into an order, as in trapped you, or stopped you out? And if you ask yourself that question, I'll add that onto Wyckoff. Wyckoff says we talk about the composite man and we say that this is one entity. Okay, that makes it easy. Nasty, nasty traders over here trying to take our money. Fair enough. But then we have to ask ourselves the question, okay, well, if they're nasty and they're sneaky and everything, would they have gotten this through to us? As in, like, would they have trapped us if we were trading that market? And I would argue most likely they would have done a pretty good job here. And specifically, if they'd then, after this one, created a new little bang bang like that, oh, that would have been really sneaky of them, a full reverse. But what you'll notice in these selling climax kind of areas here, or these selling thrusts, effectively what happens is it instantly buys back up and creates bullish hammers. Another very clear sign of usually false moves, false breaks.
Absolutely clear sign of the fake out is a hammer or a shooting star.
What did we see on the DAX before, Ty?
The shooting star.
Exactly. And this is where theory and reality start to come together and you go, ooh. Now, this doesn't mean that you can spot it straight away. Again, do I know that this is going to be the selling climax and this area here is going to be obviously the rally that puts the point in? No. I usually will start to spot it right around this area here. Okay. So at this point, we actually can start to say, okay, is this Wyckoff accumulation? Now, we'd also love volume to be with us. And we haven't gone through the volume analysis so much today because this is a currency. But in volume, we would love to see lots of volume. Remember one of his rules? One of his rules was lots of volume. If there's lots of volume into the short, then we want to have lots of volume continuation through here. Yeah. And then we break out. So this is a very classic one, certainly a good one. Let's have a look over here. Let's see what's going on. So I bought this particular currency up because I thought it had a few. Now, there are sometimes little Wyckoffs in the trend. In essence, something like this. A little bit of distribution in the trend here, or in this case, I guess he would call it accumulation. We get some nice false breaking to the downside. Obviously, there's kind of the beginning. We get this upward thrust. We get boom, 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 boom. Sells off, false break, sells off, grabs liquidity, breach of the top. Okay. So this type of little thing here, if you know what you're looking for, actually a very solid trade, very solid trade. Great, really impactful kind of area here of accumulation before the next zone. And it has all of the hallmarks again, the false breaks to the downside, the big rallies instantly coming off that. Tyrone said before, the bullish hammers. You know, then we have all these little rejection wicks over here that then get closed above. I mean, I love that kind of thing. Like if I see that, I'm like, oh yeah. And the other reason I wanted to bring this one up, Ty, was because in essence, when we go over to a daily, what could potentially, and we don't know it's going to, but what could potentially be setting up right now? We've had some form of real euphoria, some kind of climax over here. We've obviously come down, we've formed, we've come back over. And this is just on one chart that we just picked out at the moment. We're back up here. Now, depending on how this forms over time, and depending on how long it sits there for and does its little dance, it could be in reality a distribution on euro yen. Another one that could be a distribution is something like copper. Here's the beginning of it. Here's the buying climax. Here's the retest of that. Here's an upward thrust that could be a false break. We don't know yet. This is copper. You know, all of a sudden you're looking at it, you're thinking, do I see this a little bit differently? Maybe we do.
And for the naysayers that would say, well, it's all good in hindsight, all that's going to be required now on the copper weekly is for price to break down below the 20 moving average and start making a series of lower highs and lower lows and start tracking down to the yellow. Can we trade that? Yeah. Would we trade that? Yes. And when it gets to the yellow, are we going to say that, that was all in hindsight. Well, no, because we've already scalped our way to the bottom base. We're already nearly at phase E at that point, and here it is setting up. And this is the whole point. And this is what we said earlier. Like, it's no point, identifying phase A or B too early, because there's not a hell of a lot you can do with it. But at this point in time, we're looking for the sign now to get below the 20 moving average, make a series of lower highs and lower lows. Happy days. Then we're in an area of the pattern that we can actually trade it. You don't have to wait till the actual breakout once you've identified it. Let price action do the rest.
Absolutely, Ty. So, look, what a great session. I mean, obviously, I think we bring a lot to this one, and I think the community, hopefully you guys enjoyed it. Please do, again, give us a thumbs up. Some great questions coming through here. We might read a few of them in a second. But Ty, really, in essence, obviously, Wyckoff is a concept you can bring in along with your other trading concepts to recognize a certain market condition. Not all trends end with a Wyckoff. They do not, okay? Yeah. It is one of the ways that trends end. And if you can spot it, you can trade it effectively. And as we asked before, I hope you guys said accumulation, which you did. Most of you said accumulation. That's the one we would prefer because, of course, if you're in an asset class that theoretically should go up over time, that is stocks, indices, commodities, etc., the accumulation will be stronger than the distribution in terms of how far it will go after that. But look, these are just some examples. We hope you've enjoyed. Obviously, if you are interested in finding out more about what we do, you can do so over at www.fx, that is F for Freddy, X for Xavier, evolution.com. We do have some courses that you guys can look at. Otherwise, we hope you've enjoyed it. Tyrone, do you have anything else you'd like to tell everyone, or do you want to answer a few questions here?
I do. Look, if you're not already a member or a subscriber to the Pepperstone YouTube channel, make sure you do, because all of our webinars are there, including this one. It will be recorded to answer some of the questions that we were talking about. And also, we are only 2 or 3 days away from Easter. So if you would like to actually discuss Wyckoff in our community, we talk about our community all the time. We think it's the best community in the world. And just ask our members, because they say so too. We've got an Easter sale for actually the annual community subscription. I'm going to paste that into the room now, actually. So you can take a look at that, because it is a 25% off for an annual subscription, which basically makes it a no-brainer decision to actually be part of the community where we talk about this. The community talks about these setups as they're happening. And of course, you get all of the live streams that we do on a daily basis, actually twice a day. And any patterns that are actually happening or occurring, you can actually jump aboard and actually do have them alerted to you, really, which is probably part of the important thing. The reason why we love a community is because we've got like 10,000 sets of eyes instead of just the 4 that Thomas and I own together.
Well, he's saying we're like some kind of centipede or something. I don't know what that means. All right. Okay, guys. Well, thank you so much. We've got a quick outro here. And obviously, we would like to always thank Pepperstone. We'd like to thank you. And we hope that you can use potentially Wyckoff as an additional extra into your trading arsenal. So remember, there's always a great humility. This is a quote that is not mine, but there's a Druckenmiller quote here. And he says there's always a great humility that he sees throughout all great investment managers. And that humility is that they are more willing to talk about their losses than their winners. And what that means is that even though they are successful, even though they manage billions of dollars, they still have to remain humble if possible. That is something that hit me a lot over the last decade. And I'll tell you what, if you can do it and you can bring yourself back in, it's worthwhile, because I need you to ask yourself a question and answer honestly at the end of this chat here. Have you been burnt by thinking that you're a god in the markets? I'll put my hands up. I've done it. Yeah. I was a god and then I wasn't. Yeah.
Yeah, now everybody has. Look, guys, we are at one of the serious points of the year. We thank you so much for your support so far this year already. We're going into Easter. We wish you all a very, very happy Easter, and we look forward to being back with you in a couple of weeks doing the next Pepperstone webinar. If you do have a topic that you would like us to cover that we haven't covered already and you want us to be specific on it, please let Pepperstone know, because we love bringing what you guys want to the community. If we don't know anything about it, we will tell you so. We are very, very happy to try and bring the content that you really need us to bring. So we look forward to seeing you in a couple of weeks. Have a great Easter, and thank you very, very much for your support so far this year.
Thanks so much, everybody. We'll leave you with the outro. See you for now.